All right, so let's start with our static budget variances. I just want to really quick to remind you what's up with the board. Here's what it is. All right. So just really quick. Can we? Oh. Can someone just send a list to take an attendance? And everyone just sign that sheet, please. Okay, so static budget variances, but let's talk overall on this slide. So we have our definition for flexible budget variance and for sales volume variance. So what are we talking about here? We have some results that are actual and some that are budgeted. Our actual results are the ones that we got at the end of the month, at the end of the period, right? Whatever that is. Our budgeted numbers are the ones that are from the flexible or from the static budget. Your static budget is the one that's master, okay? It does not have any of the actual numbers. It's just something that's predicted. That's your master budget. And then we also talk about the flexible budget. Okay, flexible budget is something that gets adjusted while we are in the period. Okay, so we'll talk what's the difference between them in a second. All right. So really quick. I want to remind you, how do we put together our income statement performance report, and how do we calculate all of the variances that we can get out of this report. So we talked that we have our flexible budget variance, sales volume variance, static budget variance, and then we also calculate flexible budget variance as a difference between actual results at actual prices and flexible budget for actual numbers of units sold. And the sales volume variance is the difference between flexible budget for actual number of units sold and the static master budget values. All right. So let's see really quick. On the opposite sides, just as you would guess, our actual results at actual prices is what we get after the period is done, and we have some volumes for sales revenue for units that happened right there on the market, okay, that actually happened for our business. And then on the very right, you have your static master budget. That's something that you budgeted for, okay, that's your predictions. That's not actual numbers from the market, right? That's not your business operations that give you these numbers. All right, and then we have our flexible budget for actual numbers, number of units sold. So what do we have? It's our budget, right? But here we use the numbers of units sold that are from our business operations. We got it, the real numbers for our business, okay? They're from our interaction with the market, okay? That's not the budgeted. The rest is budgeted, but the actual units are the units that are sold, okay? So it's a marriage of two, okay? The polar right and the left. Yes?
So a flexible budget is a budget compared, but the units are the actual units sold.
So the flexible budget is going to have several variations for us, ranges, right? And once we get the market numbers, okay, we know that from our business operations, we've sold 10,000 units. So we look at our range and we find where we are, and we use that part of the flexible budget. You remember how flexible budget had a couple parts? So that's what it is. So you see how your actual results, right? And it's 10,000, and that's how you move that number here. You utilize it right here. Mm-hmm.
The difference between flexible and static is that static doesn't have a range. Static is just a budgeted amount, that one number that you guess.
Mm-hmm. Yeah. Okay. All right. So in your flexible budget, when you were calculating those ranges, you utilize different tools to compute your sales revenue variables and such, right? The actual real number is just the units, okay? It's just like your master budget calculated. The only difference is that you change the units, right? You take the real number. All right, so what else do we have? When I have to find out my sales volume variance, what do? I take, let me go with 2. So we'll be looking at the flexible budget variance and the sales volume variance for a second. My flexible budget variance is the difference between the actual results at actual prices and flexible budget for actual number of units sold. All right, so when I calculate, for a second, let's look at the column flexible budget variance. All right, let's look at this column right here. So each of these we calculated by subtracting the right column from the left. Okay, the column 1 minus column 3 gives you column 2. So as an example, units, we know it's a 0. It's the difference between the actual and the flexible, right? And we use the actual units sold, so it's logical that it would be a 0. Then we look at the sales revenue, and it's 121 minus 120,000, right? We got 1,000. And now we have another thing that we need to understand here, when it's favorable and when it's unfavorable. And once you understand, you can actually define it. Is this change in sales revenue favorable or is it unfavorable? Okay? So if my actual results for sales revenue were greater than the flexible budget results, that's a good thing, right? So it's a favorable number. All right. So, and just like that, going down the column, I calculate the rest of the numbers. And now let's look at the sales volume variance. Sales volume variance is the difference between flexible budget for actual number of units sold and the static budget volumes, right? So it's column 3 minus column 5. Again, we calculate all of the units, so let's look at the variable expenses. Our flexible budget tells us, okay, it's 80,000, and the static tells us it's 64. So because we're talking about the expenses, we would like them to be lower, right? So if my, once I plug in my actual units sold, I see that my variable expenses is higher than the static budget ones, right? Is it favorable or not? It's not, right? I'm actually using my units sold, right? So it tells me that likely that my expenses are higher than what I planned, okay? Because I'm using the range. Yes?
How are you getting the 120,000 for sales revenue and 80,000 for variable expenses and so on?
It's a good question. I might ask you to actually calculate it, but more likely it's given to you, and you would, you know, use the knowledge of how you calculate the variances to compute variances for the, if that's a question for the exam, right? Now I understand that this is an income statement. You know how to put together an income statement, right? So if there is a question to put together an income statement and then calculate, you are going to be given numbers so that you can put together where is an actual, where is a static, right? So plenty of information would be given to you. Okay? All right. Okay, and then we also have a static budget variance. The static budget variance is going to be a difference between the actual results at actual prices and the static master budget. So let's look just a little bit in details. Yes?
The static budget variance. Why would that be the same again?
We'll talk just in a little bit in more details about this, okay? All right. Before we do that, let's try to figure out if we are clear on the definitions. All right? Okay. So consider the following definitions. Give the cost term to the correct definition: flexible budget variance, sales volume variance, static budget, and variance. So I just reminded you the main points, okay? All right, a summarized budget for several levels of volume that separates variable costs from fixed costs. Several levels of volume that separates variable costs from fixed costs. What kind of the definitions itself are given to you, right? It's flexible budget variance. They're right here. They're the ones that you're going to be using, right? Right here. So what is it? Several levels of volume are presented to you, separating variable costs from fixed costs. It's a flexible budget. That's right. All right. The budget prepared for only one level of sales volume. Just one level. Static. Okay. The difference between an actual amount and the budget. Variance. Very good. The difference arising because the company actually earned more or less revenue or incurred more or less cost than expected for the actual level of output. Huh? It's some type of variance, yes. The difference arising because the company actually earned more or less revenue or incurred more or less cost than expected for the actual level of output. Yes? Nope. Why is it flexible? Yes, that's right. And the difference arising only because the number of units actually sold differs from the static budget units. Right? It's our sales volume variance. All right. So you can see from here, flexible budget variance takes a little bit more than just the change in number of units sold in the definition of itself, right? It's because the company actually earned more or less revenue, incurred more or less costs than expected from actual levels of output. All right. So let's try this 23.3. We'll try to prepare. Now we'll learn bits and pieces. We're going to dissect the concept of these variances more and more. Okay. So let's look, how do we put together a flexible budget? You understand, flexible budget is just this between column 1 and 3, right? Just one part of it. Okay. Let me show you. So our flexible budget, that's just this part right here, right? We're just going to concentrate on how our flexible budget numbers of units sold and how do we calculate the variances, okay? So we're just looking at the left side of the column right now. All right. So the budget selling price is 19 per lock. Variable cost is $8 per lock. Budgeted fixed costs are $15,000. And we want to prepare a flexible budget for output levels of 4,000 locks and 7,000 locks for the month ended April 30th, 2012. So we're going to look at the budget, right? That's going to have two output levels. One is going to be at 4,000. The other one is at 7,000. So your column, now close your eyes, let me check. Oh yeah, it has numbers. Okay, so we're going to put together a table right now. That's your flexible budget. In your flexible budget, we just talked that there is a sales revenue, variable expenses, contribution margin, fixed expenses, and at the end, obviously, we want to see our operating income, right? So let's do that. You're probably going to need no more than 5-7 minutes. So once you get your operating income for both, let me know what the numbers are, and I'll look around how you guys are doing, okay? Flexible. You're going to have your sales revenue, variable expenses, right? That's what you need to put together. Sales revenue, variable expenses, contribution margin, fixed expenses, and operating income. Okay? Yes? Are you not recording me?
I'm not on backup yet. I've been trying for the last 15 minutes.
Sure.
See if it works with yours. So I can't connect to the internet with this thing. See, I don't have that either. Try capital RBS 1, 2, 3, 4. Maybe it'll work. Nope. I'm trying the NCSW LAN. It's not working either. I don't know what's going on.
You want to take my laptop?
Do the join me and everything?
Mm-hmm.
Would that work, you think? I'm gonna go down to the office and see why this is not connected.
You want to use my laptop?
Let me run down there and see if it gets. I mean, right now that's recording okay, so.
Okay. Mm-hmm. Mm-hmm. Doing good? Mm-hmm. Yeah? How are you doing? How are you doing? I'm recognizing this number. I'm recognizing this. Good job. I don't know what this is. You're probably still calculating something, right? Oh yeah, I do see this number. Good job. Mm-hmm. Do you have your, you don't have any other notes? Do you have a laptop? Can you, something? Doing okay?
I'm still working on it. I don't know yet. Probably not.
Doing okay? Are you getting it?
Professor,
Mm-hmm.
do you just have one final of like May 13th? Or something?
No, it's not May 13th. I'll let you know in a little bit when the exam
It's
is.
not on there?
We don't have a room.
Oh, it's before or after?
It's 6th.
May 6th?
May 6th?
Mm-hmm. May 9th is the reading day. Thank you so much. Oh, I even got your IDs. You didn't have to, but thank you. you doing?
I'm just looking through the textbook.
All right.
Turning.
Yeah, you looked up. Good job. So how are you doing? Very uncomfortable, right? How are you doing? What did you get? Yeah, you're right. Good job. Doing okay?
Yeah.
Mm-hmm. Any questions? Okay. You getting it?
29,000.
Yes. Good job. So the numbers I'm hearing for operating income is 29 and 62. Everyone is getting it? Good job, because you might see that's why I'm spending this, all this time on the question. You should be like already calculating something else. Good job, Sylvia. Getting it? I'll show you in a second. All right, so, a question like this is a good question for the show your work, right? So let's see how we calculated it. So we have a table just like that. And what we do is separate the output, right? We need one for 4,000, another one for 7. Okay, so we have our sales revenue calculated, variable expenses, contribution margin, fixed expenses, and that gives you different levels of operating income, okay? So we'll have more problems on what are we doing next. Right now, I just want you to understand how you put together the flexible budget. So here's what it is. We said, so once we have this flexible budget in place, if, for example, that month I produce 7,000, I can go back in here, I can look at these numbers, right? And that's what I'm going to be comparing, right? So these are your different levels of output, okay? That's a clear definition of flexible budget. We're going to have different levels of output, okay? Just in case you see it somewhere else. All right. Yeah? Okay, so let's look at the third one. A third objective is to identify the benefits of standard costs and learn how do we set those standards. Okay. So now just a little bit of theory. No worries, we'll have plenty of calculations in like 2 slides. Okay, so what is a standard cost? Many companies are going to use your standard cost for developing flexible budgets, okay? So what it is, in fact, is a budget for a single unit, right? We can calculate this budget for a single unit. Just think of the standard cost as a budget for just one single unit. Okay, we also have heard that there is something called standard costing system, right? We had this pretty sure on the exam. All right, so in the standard costing system, each input has both your price standard and the quantity standard. So what does it mean for us? It means that your price is going to, it's a price, it pays per unit for materials in each unit produced, and also the amount of materials for making that unit produced, okay? So we have each unit with 2 factors, price and the quantity, and the inputs that we're going to be using is direct materials and direct labor. So for direct materials, the price is going to be unit cost of materials in each product, and the quantity is your amount used to make each product. Now for direct labor, just a tad difference, just a little difference. The price is your wage rate for employees that are involved in making that product, and the quantity is going to be the time that was used to make that product. Why do we need this? Practically, it's based on what the purchase price is. Based on what the purchase price is, managers are going to make a decision at what level the cost per unit of material is, and based on the production cycle and the levels of production cycle, the manager is going to set a certain quantity produced of each product. So really quick, what are the price standards? So price standards are going to have a couple components. It's direct material, direct labor, and manufacturing overhead. Okay, for each of them, in its turn, we're going to have certain standards set in place. For direct materials, our base purchase cost of each, it's a base purchase cost of each unit of inventory. We're going to consider our early pay, discount, freight ins, receiving costs, and so on and so forth. And then managers are going to look for ways to cut those costs, okay, for direct materials to directly impact the bottom line. And then accounts are going to work with purchase managers to set those price standards in place. So accountants will help managers to set those price, why do we need them, right? To set those price standards for materials after they consider early pay discounts, freight in, receiving costs, okay, and such. All right, so what is for direct labor? We'll consider our pay rates, payroll taxes, fringe benefits, and our accountants are going to work together with the human resources for determining labor rates. And the other one is, the last one is the manufacturing overhead. Accountants are going to work with production managers to estimate our overhead costs, manufacturer overhead costs, and then production managers will identify appropriate allocation base. What that could be, it's probably your direct labor hours, direct labor costs, and such. Okay, so just setting in a little bit of theory before we start calculating all of it. Now, what are the quantity standards, right? We just discussed with you, we just said that standard costs have two parts, right? Price and quantity. We just discussed price standards. Now let's look at the quantity standards. So what are the quantity standards? They again have three parts. It's direct materials, direct labor, and manufacturing overhead. Now just briefly, direct materials, we analyze every input in the production cycle, and then we consider what are the product specifications, scheduling, spoilage, and such and such. For direct labor, what we're going to do, we'll consider the time requirements for production, experience, learning curve, and then we're going to use time and motion studies for benchmarking. And the last one is your manufacturing overhead. What we're going to do, appropriate allocation base chosen. And with that, to determine that, our accountants are going to work with the production managers. All right. So how do we compute those standards? Again, let's go back to our Smart Touch technology company. They might want to determine its production cost standards for materials, labor, overhead. Okay, so first let's look at our direct materials price standard for the product vinyl. Okay, so we're determining our cost standard for material right now. All right, so we have purchase price net of discount. It's given to us that it's $1.90 per square foot of vinyl. And we're going to also know that delivery, receiving, and inspection are going to add on average 10 cents per square foot. Okay, so we're going to sum those up together. Our total standard cost per square foot of vinyl should be at $2 per square foot. The next one is the direct labor price or rate standard. We'll also calculate this. We know that Our hourly wage is given as $8 per direct labor hour. That's not just our hourly wage for workers. We also have some payroll taxes, fringe benefits, and that should be at $2.50 per direct labor hour. We sum those two up, and we derive our total standard cost per direct labor hour at $10.50 per direct labor hour. Okay. Now the next one is the variable overhead price or rate standard. So how do we calculate this? Just a little bit more complicated. So let me explain to you. Variable overhead will total at $6,400 based on 8,000 DVDs. That's something that we derive from the static budget. And then our let me show you both. Okay. We also know that our fixed overhead is $99,600, and what should be always given to you is the overhead allocation base, and that's 3,200 of direct labor estimated hours. Okay, so we divide our estimated variable overhead cost or estimated fixed overhead cost by the quantity of allocation base that's also estimated, and we derive respectively variable overhead price standard or the fixed overhead price standard. Okay, so that's your calculation of the standards. Now let's look, how do we actually apply? Why do we need this? We'll see how it ties all together. So let's get back for a little bit to our variance analysis. Okay. All right. So once we establish these standard costs, we need to assign cost to production. Right? We can use these standards to assign this cost to production. All right, so at least once a year, we're going to compare our actual production cost to standard cost and see what are the difference to see how we can change the process. All right? You okay? Yeah? Okay. All right, so let's look at this variance relationship. Just a second. Okay. So we have our actual prices, standard prices. Just picture it over that complex table that we had of 5 columns, right? Now let's learn how do all of these quantities and prices relate to each other. So we have our actual prices and standard prices, okay? And in its turn, we are obviously going to have some actual quantity and standard quantity. The standard one is the one that we derived from the master budget, right? All right. So how do we separate total variances for materials and labor into price and efficiency quantity or quantity variances? So from this relationship, we can derive how well material and labor prices are kept within standards and how well a company uses its materials or human resources. Okay? So by multiplying each related number, either it's an actual or the standard price or quantity, we can find our price variance, efficiency variance, and the total cost variance. Okay? So what is your price variance? Your price variance is the relationship between the actual price and actual quantity and the standards, right? And then to the right, your efficiency variance. So price variance is your actual price by actual quantity. From that, you're going to subtract your standard price and actual quantity. That's your price variance. And then the next, your efficiency variance is the difference between your standard price, actual quantity, and standard price and standard quantity. All right? And the total cost variance is the difference of the two. Okay, so that seems like complex. Let's zoom in. How do we calculate our price variance? So the price variance measures how well the business keeps unit costs within standards, right? We just said right here how well material and labor prices are kept within standards, right? Just let's look at the price variance for a second. So it's the difference in price of an input multiplied by the actual quantity used. So let me show you it as a formula. Our price variance is the actual price multiplied by actual quantity less standard price by actual quantity, right? Or if we move them just around a little bit and we take the actual quantity out, what do we get? We have a difference between the actual price and the standard price multiplied by the actual quantity, right? Whom I did not lose. Good, +1. All right. So short, just for you to remember this, it's an actual price minus less standard price, and we multiply by the actual quantity. Okay. All right. So to add more, our efficiency or quantity variance. Now this one, that's this side, right? So we're done here. We're just working how well a company uses its materials and human resources. Okay? So it's our standard price multiplied by actual quantity, right? Just like that. Okay, so let's look at the formula. It's going to measure how well the business uses the materials or human resources, and it is a difference in quantities multiplied by the standard price per unit, right? Okay, so efficiency variance is your standard price multiplied by actual quantity less standard price by standard quantity. So what can we take that's in common out of the brackets? That's the standard price, right? So we get our actual quantity minus standard quantity multiplied by standard price, and that gives us efficiency variance, something that measures how well the business uses the materials or human resources.
You can choose the top one or bottom one.
The bottom one. For calculations, the bottom one makes sense, right? The top one is more to understand what you're doing there, right? But if it's just the problem, then use the bottom. All right. So now the fun part. How do we put all of these together? Let's remember that table, table that I showed you, right? It's somewhat, it has just a little bit on added. So what do we have here? We have all these different variances. So let's figure out the relationship among price, efficiency, flexible budget, sales volume, and static budget variances. So remember that table back where you have your actual results, right? Some results from master budget and then some that are flexible, and in between we're calculating all sorts of variances, right? Okay, so we have our actual results all the way to the left here. We have flexible budget that's based on actual numbers, right? And we also have our static budget that's using some budgeted expected numbers of units sold. So when we are calculating our variances between our actual results and the flexible budget, we can find our flexible budget variance, and we can find our sales volume variance between the flexible budget volumes and the static or master budget. So what this table illustrates is that the price and efficiency variances add up to the flexible budget variance, okay? Your price variance and the efficiency variance is your flexible budget variance. Okay? Just for you to remember, that's your actual price. Can I write with this? Yes. So that's our actual prices, our standard prices, and then what do we multiply it by? By some quantity, right? All right. Okay. Now, what is my efficiency? What's the difference between efficiency? That's quantities, right? All the quantities. So it's actual quantity minus standard quantity, and we multiply it by, okay? So if you add those two up, it's your flexible budget variance. Oh, I'm sorry. I meant quantity. Yeah, and it's an A. All right. So the second, our static budget plays no role in the price and efficiency variance. Do you see that? Does not utilize any of the numbers from the static budget. Okay, it has no effect on it. Good multiple choice question. Should know that. All right. Just give me a second, I had an idea. All right. So let's look further. Our static budget is used to compute the sales volume variance only, right? So your price variance, your efficiency variance, and the flexible budget variance is the calculation between the numbers of actual results and the flexible budget. And your flexible budget and static budget numbers are only related through the sales volume variance. That's it. All right. So number 4, how do we compute sales standard cost variances for direct materials and direct labor? All right. So let's look at the flexible budget variance here. We have again our income statement for the Smart Touch learning. So we figured that flexible budget, we have it here calculated. That's the 4,000 is unfavorable flexible budget variance for our operating income. So the first thing that we want to do is to investigate what caused this cost variance to be unfavorable. How do we get to 4,000 of flexible budget variance that's unfavorable? Okay. All right. So how do we calculate our flexible budget and where is it coming from? So these two are panels right from your book. They are the computation of flexible budget and actual results. So let's look, how do we compute? We're given our direct materials, direct labor, and variable overhead. Okay. So your we know the volume is 10,000 DVDs, and so we're given some information to compute the direct materials. We know that 1 square foot per DVD is your quantity, is your input, sorry, and you have 10,000 DVDs as a quantity, so you get your standard quantity of 10,000 square feet. the same way you given your direct labor as an hours per DVD and the volume of DVDs, so you compute your direct labor and variable overhead. Okay, so you also know your standard price per unit of output, which is for direct materials $2, direct labor $10.50, and variable overhead is at $2. So what you do, you take your standard quantity of input allowed for that amount of production, you multiply it by your standard price per unit of output, and you get your flexible budget. Okay, so it's 10,000 multiplied by $2, you get your 20,000. You take your 4,000 hours multiplied by $10.50, you get 42,000, and 4,000 hours by $2, 8,000. Okay, so you calculated your flexible budget, great. Now you need to calculate your, to show your computation of actual cost for direct materials and direct labor for the same amount, for the same volume of production, 10,000 DVDs. So for direct materials, you see your actual quantity of inputs that were used to produce 10,000 DVDs is 12,000 square feet. Okay, so we estimated at first that it would be just 10,000. It turned out to be 12,000. Okay. So I know my actual price per unit of input is $1.90, which was the actual cost per square foot. I estimated my standards at $2 of cost per square foot, and now I have my actual cost for 10,000 DVDs. Okay, so here you go, it's $22,800, and I do the same for direct labor. I overestimated my, right? Did I overestimate or underestimate? Did I underestimate? Yes. I'm over, that's right. So my 3,800 hours actually used for direct labor was overestimated in my flexible budget, right? And I have my actual price of $11 per hour. And so I find my actual cost as a multiplication of the two at 41,800. Okay. So that's your standard costing example. Now, great. Okay, so we found that. Now let's look, how do we compute the variances? At first, let's look at our materials. We just found the two numbers, right? 22,800, 41,800, and we also have our flexible budget calculated as well. Okay, so we have these two numbers for direct materials and direct labor. Now, to compute variances, we're going to use the cost that we computed for flexible budget and actual results, just the slide before. So let's see, how do we get this 2,800? $2,800 is the difference between the direct material for actual results at actual prices and the flexible budget for 10,000 DVDs, right, level of output. So flexible budget is the difference of the two, and that's 2,800. Why is it unfavorable? My actual numbers are higher than what I predicted, right? What I estimated before. All right. So that's an example for you how we track where this unfavorable or favorable variance comes from. Okay. All right. Direct material variance. So let's just zoom in a little bit on direct materials. We have two types of direct materials. It's our direct materials price variance and the efficiency, right? We just talked about it a little ago. So again, our materials price variance is the same concept. It's the difference between actual price less your standard price multiplied by the actual quantity. So how do we calculate this? We are utilizing the same numbers. We take $1.90 per square foot, subtract $2 multiplied by the square feet total. All right, so we found, by that you can actually find if it's, if you are calculating, all right, let me just tell you this. If you forgot, is it actual or is it standard, okay? And you put standard price minus actual price and you multiply it by the actual quantity, that's okay. Okay, it's better if you remember, but if that happened, just check yourself. Don't trust that if it's a negative number, I'm going to put it as favorable. Try to understand what is actually behind that number, okay? So what am I doing? I'm taking my standard price, I subtract from actual, right? And then I multiply by the quantity. So what does it mean if I'm comparing my standard to the actual price?
So if your
Okay.
standard is more than your actual, that's unfair. So you can look at it starting out.
Uh-huh. Why is it unfavorable? Why is it favorable?
Is it less expensive?
Okay.
So I'm already starting out, you know it's less expensive.
That's exactly what I want you to do, right? Don't try to memorize all the formulas. This is so much for the exam, okay? You're not going to be able to do that. Try to understand why is it a U and why is it an F, okay? It's favorable because, just like you just thought it out loud, right? Just like that. Okay. And then I also have my direct materials efficiency variance. And direct materials efficiency variance is the difference between the actual and the standard quantity multiplied by the standard price, right? Okay, so again, I have all the numbers to calculate it. I take my 12,000 square feet minus 10,000 square feet and multiply it by $2 per square foot. And that's my calculations of the 4,000 of unfavorable. Okay, so let's look at the little table that I showed you just a little ago. I have actual prices, actual quantities, and I found that it's 22,800. Okay, just right here. We're looking just at our price variance left side. And then I also have my standard price multiplied by actual quantity, which is $2 by 12,000 gives me 24,000. Okay. Note, it's the same thing, it's just written out, right? As an AP, AQ minus SP, AQ. Yeah? So this part, just going to be really messy, but for you to understand, is here, and this part is right here, and it's just the difference of the two, right? My actual price, actual quantity, standard price, actual quantity. Okay, the difference of the two is going to give me this price variance of 1,200. Okay, now here is a good moment for you to try to understand. My actual price and actual quantity is less than the standard price and actual quantity. What does it mean to me? The difference is in actual price and the standard price. And if you look a little more, my actual price is less than standard price. Why is it favorable? The lower. So that's why I'm going to put an F next to it. Okay? So if you do not remember, was it Q, was it F, was it A, too many letters, just remember this. It's easier for you to calculate this way. Okay? And the same goes for your efficiency variance. It's your standard price, standard quantity, right? And it's the difference between your standard price, actual quantity, and standard price, standard quantity. All right? So how do I calculate? Now we know this. Okay? We know how we calculate price variance. We know how we calculate efficiency variance. How do I calculate total materials variance? Huh? Which one from which one? Huh? So I take my price variance and efficiency variance?
Yeah.
All right. Or do I take maybe my standard price, standard quantity, and actual price, actual quantity? Or is it the same? Is it the same? If I take my price variance and subtract efficiency variance from it, is it the same if I take actual price, actual quantity, and subtract from it my standard price, standard quantity? Why is it not the same? It's the same thing. Here's why. If you write it out, you have standard price, actual quantity on the left, you have standard price, actual quantity on the left, on the right, you're subtracting them. So they're just going to cancel out, right? So just the difference between the two. You calculate whichever way you want. You can just take your price variance and the efficiency variance. Or you can take whatever you want. All right. Some of you I see are still present here, so let's move forward. There are more formulas. Feel so bad for you, but no other way. So let's look at the labor. How are we going to compute the variances for the labor? We're going to use the cost computed for the flexible budget and actual results. Okay, so how did we get this difference of 200, and why is it favorable? We see that direct labor is at 41,800, we just calculated, and 42,000. All of it we just calculated a couple slides ago, right? So the flexible budget is greater than the actual. That's your direct labor. Why is it favorable? That's right, right? The labor cost was cheaper, okay? Don't forget to look, this is your costs, right? That's your cost. You want it to be as less as possible, and that's why it's going to be favorable. All right, more. Direct price variance and direct labor efficiency variance are the two types of direct labor variance. So we calculate our direct labor price variance as the difference between the actual price and standard price multiplied by the actual hours. And the direct labor efficiency variance is the actual hours, standard hours, the difference between the two multiplied by the standard price. All right? So how does it look? Looks just like this. The price variance is the difference of the two, right here, actual price, actual hours, and the standard price, actual hours. And the efficiency variance is, again, the difference of the two. Now, at the very bottom, the total labor variance is going to calculate just like total materials variance, okay? So although the words are different, it's really the same calculations behind it, okay? So once you understand how it's calculated, it should be very easy to you. So we multiply actual price, actual hours, we subtract our standard price, actual hours, and we get the price variance. And the standard price by actual hours minus standard price, standard hours, you get your efficiency variance. Now, total labor variance is the difference of the two, right? All right, the fun part. Let's calculate. 23,600. Okay, so it's a manufacturer of lit crystal glasses that provides this material variances calculations for us. The standard material quantity is 0.8 pound per glass at the price of $0.3 per pound. The actual results for the production is 6,900 glasses, was 1.1 pound per glass at the price 0.4 per pound. Okay, so let's calculate the materials price variances and the materials efficiency variance. So how do we calculate the materials price variance? You know what, we'll do the direct labor by yourself. Let me show you this one. So materials price variance, we know that's the difference of the actual price and standard price multiplied by the actual quantity. And therefore, the way we're going to calculate it is 40 cents per pound minus 30 cents per pound. All of it is given to you, right? We multiplied by the 6,900 glasses and 1.1 pound. Why do we calculate this way? That's right. So I have to add this, right? Have to read very carefully. Okay. So that's going to give me 0.1 per pound. And we'll multiply, we need pounds and pounds, right? We don't have to have the same. So we have dollar per pound multiplied by pound. We're going to get our price variance at the end. And that's 759. Why is it unfavorable? Why do I put it as unfavorable? My actual is 40 cents. My standard is 30 cents. My actual is greater, right? My actual is greater. All right, so direct materials efficiency variance is the difference between actual quantity and the standard quantity multiplied by the standard price. So again, my actual quantity, just like I did here, I need to have everything in pounds, right? So I took 6,900 multiplied by 1.1 and subtracted 6,900 multiplied by 0.8. And my standard price is 30 cents, all given to me, right? So by calculating this, I find that it's 621 and it's unfavorable. Why is it unfavorable? My actual results for production was 1.1 pounds per glass, right? And I only, my standard was 0.8, right? My standard was less than my actual. Why is it unfavorable? I'm spending more than I planned, right? All right, so we'll start next class. We're going to have a quiz right now. We'll start next class with the labor variance. I hope you're